Welcome to Chapter 10. In previous chapters, we've talked about what the cost of capital is, and this is the chapter where we're going to actually now kind of learn about it and what it means and how we calculate it. So that's the main topic for the week. You can kind of see the other topics here, just the sources of capital, components of capital, and so on. And this is a good slide to kind of help you understand where does capital come from. So just think capital is resources. Corporations, businesses need resources to go out and expand, launch new products, do what they do. And so the sources of capital are three: debt, preferred stock, and common stock. Now, under debt, companies can do short-term notes payable or more long-term debt. And generally, long-term debt would be more like bonds, long-term bank loans. And then common equity includes both retained earnings, so basically your own earnings that you keep, and the issuance of new common stock. But the big three are right in the middle here, but keep in mind debt has two components and equity has two components. Common equity has two components. So the formula for the WACC computation is right here. It's very important that you know this formula. So jot that down in your notes or just keep track. It's on slide 4. It's obviously also in your book. And the WACC is the WACC equals, and then wherever you see a W, that stands for a weighting, and the sum of the three W's would always be 100%. So WD for debt, WP for preferreds, WC for common equity. Then the R's are returns, the required returns. So basically it's an interest rate. So R sub D, R sub P, R sub S. And then just for debt only, you have 1 minus T, where T is the tax rate. Now, it asks in the book, some of the first few pages of the chapter, do we focus on before tax or after tax? And the key is we always focus on after tax. So when we talk about cash flows in finance, we always talk about after-tax cash flows. And so we always focus on after-tax cost of capital. Now, however, of the three main components, only one of them have the T, the 1 minus T, and that was debt. So debt is the only one that requires an adjustment for tax because interest is tax deductible. Okay, and also it says, should we focus on more historical or embedded costs or more new marginal, more forward focused costs? And kind of keep in mind that the WACC calculation, the reason we come up with it, is to be forward focused. We're trying to figure out what will the cost be in raising new capital. And so you want to focus on today's marginal cost or forward-looking costs and not your history. So it's always good to know what your historical WACC has been over time. That's fine, and you want to know that, but you really want to focus on what is my WACC going forward based on the new capital structure if I decide to go out and issue new stock, new debt, and so on. Okay, so how are the weights determined? And it says here, do I use more accounting numbers or market value? Do I use actual numbers or target capital structure? And again, because the WACC is very forward-looking, we're trying to think what's going on in the future. We want to use more market numbers. And again, it's always good to know history. That's important. And we also want to focus on the target capital structure because we do want to know what our capital structure is today, but most likely we're going to change that based on new retained earnings, stock issuances, paying dividends, maybe borrowing more money, whatever that would be. That weighting is always changing. So when I come up with a WACC calculation, I want to be forward focused. So I want to focus on the market and I want to focus on the target. And here's an example of doing that. So they use an example of a company called Coleman Technologies, and we're going to calculate the cost of capital for a major expansion. So Coleman wants to get bigger, and they're trying to come up with what their current WACC is, kind of based on information, and they're going to focus on markets and targets. So this is the calculation to help them make a decision about what their WACC is as they make a decision about how to finance expansion. So their tax rate is 25%. Right now on the books, they have a 15-year, 12% coupon, semi-annual payment, non-callable bond that would sell for $1,153. If they go about issuing new bonds, it says right here they'll be privately placed with no flotation cost. Flotation is a brokerage fee. It's a commission. So if they were going to sell bonds to the public, there'd be an investment bank that would help them navigate that process and take a commission. Basically, if any dollar raised, the investment bank would take a percentage fee for that. But they're planning on just doing a private placement and therefore would have no flotation. So it's more of a direct investment. They're aware of some investors willing to lend them money through bonds, and that's just fine. And that's actually a very good thing. It saves the company some money. They also currently have some preferred stock on the books. It says right here 10%, $100 par value, quarterly dividend payment, perpetual preferred stock sells for $111.1. Remember that perpetual means forever, so as long as somebody owns that preferred stock, they will receive a dividend. 10% of $100 is $10. They have common stock on the books. The market value of that stock is $50. The D0, the dividend today, is $4.19, and they're forecasting a growth in dividends of 5%. The beta for the company is 1.2, if you can recall the beta discussion from earlier. Beta above 1 means the stock is just a little bit riskier than the market, and then below 1 is less risk than the market. The market's beta is 1, so above 1 is riskier, below 1 is safer or less risky. Then R sub RF is the risk-free rate, which is 7%, and then RPM is the market risk premium, the extra return that you would need by investing in the market to match risk and return. And the bond yield risk premium is 4%. So basically just saying the risk premium of owning a bond is 4%. And then the target capital structure, what we expect to have is 30, 10, and 60, which obviously adds up to be 100%. So that's the key with any of the weightings. Just make sure your weightings add up to be 100%. Okay, so then they're going to show us the book value, market value, and target of their capital structure. So if we just pulled up their financial statements and we looked at their balance sheet, the book value of debt, preferred, and common is 48, 2, and 50. If we convert that more into a market value, you can see it's different, 25, 5, and 70. But the target is 30, 10, and 60. And they're really going to plan on issuing some debt. That's kind of their goal right now. So knowing that, they're going to increase debt, which would then decrease the other ones. So their goal is to go 30, 10, 60 with their weighting as they make decisions going forward with rearranging their capital structure. So that's the one that really matters. And then R sub D is the marginal cost of debt capital. And it says the yield to maturity on outstanding long-term debt is often used as a measurement of R sub D. So remember, they already have some debt on the books, right? We go back to their the setup, so I went too far. Right here, they already have debt on the books. They've got a 15-year bond, 12% coupon, that right now would sell for $1,153.72. And I can use that information to calculate the yield to maturity, which is kind of a proxy then for my cost of debt. Okay, so that's why that was important, kind of why they mentioned that. And I've mentioned why debt is tax affected. It is because interest on debt is tax deductible for corporations. So I get a tax benefit by having debt and paying interest. Okay, then the second, and this slide just shows us how to calculate the R sub D. So remember from chapter 7, we did these kind of calculations, and it was a semi-annual bond. So remember, it's a 15-year, 12% semi-annual coupon, and so we need to kind of verify that. What is the yield to maturity? Well, we calculate yield to maturity being 5, but because this was the semi-annual calculation, we have to then double that. So we have to take that 5 and double it so that the YTM is now 10. Okay, so remember that when you're calculating for interest using semi-annual, you have to double the answer. Okay, so then the after-tax cost of debt then is 10, R sub D is 10 times 1 minus T, T is being 0.25, that gets me to 7.5. Okay, and we're choosing to ignore flotation costs, just to make it simpler. Okay, so now let's do the same thing for our preferred stock. Now remember that with dividends, when companies pay dividends, they do not get a tax break. Okay, so we don't worry about any dividend we don't worry about the tax effect of that. And we're also ignoring, just to make it simpler, flotation costs. So that's just kind of getting thrown out. So you're going to have us calculate that really easy. Back in chapter 9, the equity chapter, we did a few of these types of calculations. And so the return, the R sub P of my preferred stock is $10 divided by 111.10. And recall that the preferred stock, let me go back to where they explained all that for us. The preferred stock was 10% $100 par value. So 10% times 100 is $10, and that's the dividend that we pay. So we pay a $10 dividend on that stock. So 10 divided by the price of the stock, 111.10, is a 9% cost. And it says here, is preferred stock more or less risky to investors than debt? And the answer is, it might seem odd, but it's riskier, believe it or not. And it has a higher percentage also. That R sub P was 9, and that kind of takes that into account. R sub D after the tax effect was 7.5. And so it's riskier because companies are not required to pay dividends. So the key with that, remember that when you have debt, you have to make your interest payments. If you stop making your interest payments, the bank could potentially come after you, sue you, whatever that would be, to seek repayment. You can go a while without repaying dividends, though. Now, not forever. At some point, preferred shareholders can sue to gain control of the firm. Also, if you stop paying your preferred dividends, it will negatively impact your common stock price. That will go down because common shareholders cannot receive a dividend until the preferred stockholders are caught up with dividends. So if you stop paying dividends, you do have some flexibility, but there will still be some consequences to pay. But generally, it's riskier than debt. And so why is the yield on preferred stock lower than debt? Well, the before tax was 9 compared to debt being 10. But remember that after tax, the debt was 7.5%. Now, part of it, though, is right here. It says corporations own most preferred stocks. Okay, and it says here that generally, and this number can be higher, 50% of preferred dividends are excluded from corporate taxation, and it can actually go up to 70%, depending on how much of a preferred stock that you own as a corporation. So if I'm a corporation and I buy preferred stocks of other corporations, so if I happen to own this stock that pays a $10 dividend, a preferred stock, and I receive that $10, I can automatically exclude 50% of that, or $5 of that, from my tax calculations. So I don't pay tax on half. And so that's kind of a big deal, right? So it says the after-tax yield to an investor and after-tax cost to the issuer are higher on preferreds than debt, consistent with the higher risk of preferred stock. Okay, so just kind of keep in mind a few of those things. The last one is equity and computing the R sub S of equity. So it says here the rate of return investors require on the firm's equity is often called R sub E. R sub E being retained earning, return on the equity. R sub S is usually the one that deals with earnings. So R sub S, R sub E. Then here it says, why is there a cost of retained earnings? So remember what retained earnings are. It's a company being profitable, having net income, and keeping that and then reinvesting that. So keep in mind there's always opportunity costs, right? For companies, when they are profitable and they have positive earnings, you have choices. You can keep those earnings and plow them back into your business, or you can give a portion back to your investors as a reward for investing or buying stock. There's kind of a happy medium. It also depends on what is the life cycle of my company. Is it still trying to grow? Is it competing vigorously with other companies in my industry? Or has my company kind of peaked, is more of a dominant player, more of a cash cow now, and it can afford to give out more retained earnings as dividends? There's really no right or wrong to it. It's just that you generally would not pay out all of your earnings as dividends. And this depends on the life cycle of your company if you pay dividends or not. If earnings are retained, there's an opportunity cost, right? So investors could choose, I'm not going to buy your company's stock because I'm not getting dividends, so I'm going to buy another company's stock that does pay me dividends. So you always have to kind of think of that balance between the two and what the best balance is for that company. And of course, a firm can always repurchase its own stock too if they want to. So it's just a matter of what we do with those earnings. Do we invest them in the company, pay dividends, buy back stock? Is a lot of choices, and the choices really just depends on the life cycle of the company. Where are we at? And so there's lots of ways to compute R sub S. CAPM is the capital asset pricing model. R sub S is the component of a few different calculations, R sub RF plus R sub M, M being the market rate of return, and then the risk-free rate again, times B, which is beta. And so what CAPM does is it basically says, let's risk adjust the return of this company. If the market return is a certain percent and this company's beta is above 1, this company needs to earn a return above that, above the market return, because it has increased risk. We also have the dividend cash flow model, which we looked at in Chapter 9. You hopefully remember this one. D1, the dividend a year from now, divided by the price of my stock today, P0, plus the growth rate. Or we can do the bond yield plus risk premium approach, which basically says, what's our R sub D, and add what they call that risk premium, and just to that, that'll give us our answer. So there's really 3 ways to do this. And most companies will kind of do an average of the 3. Now, recall that this middle one here, the DCF, only works if I pay a dividend. So the only way this calculation works is if I pay dividends. If I don't pay dividends, I'm left with the other ones. I can always do CAPM and the bond yield plus risk premium approaches, though. Okay, so if you can recall our company and the numbers they gave us in the setup, the risk-free rate was 7. It says the market risk premium is 6, and the beta is 1.2. So I want to point out that the R sub M is the market return, and R sub RF is the risk-free rate, and that is your market risk premium. Okay, that's the 6%. So they did not tell us what the market return is, but I can just tell you that it's 7 plus 6. The risk premium plus the risk-free rate is 13, and that's the market rate of return. So 13 minus 6, I'm sorry, I didn't do that. So 13 minus 6 I'm sorry, minus 7. I'm going to say that right. 13 minus 7 is 6. I don't know why I was stumbling on that. So 7, and this would be 13 minus 7 to get down to 6. Okay, but they just said the market risk premium is 6. Well, this calculation in the middle in the brackets is the same thing. So I take the risk-free rate plus that risk premium of 6 and multiply the risk premium by the 1.2 because I need a greater return because this stock's beta is above 1 to get me to 14.2. Okay, so then I can use my dividend cash flow approach, and they told us that the dividends today are $4.19 and the growth rate's 5, so I take D0 times 1 plus G, I get 4.3995. I can take that number, divide by the price today, add the growth rate, I get 13.8. So notice that they're pretty close. This is 14.2, this is 13.8. And then it says here, of course, this only really works, it works the best if I have consistent growth, right? I can still do this if I have non-constant growth. It's just that the calculation is more difficult. It's way easier to do if I have constant growth. And then the last one's what they call the bond yield plus risk premium approach. And the book actually explains in the chapter that the general range for this is 3 to 5%, that in general, the risk premium above a corporation's debt cost is between 3 and 5%. And so they just took a happy medium here of 4%. So our company's R sub D is 10, and we're doing the before tax one. And we're just saying kind of arbitrarily that we believe our bond yield plus risk premium is 4. So 10 plus 4 is 14. So it's very much a ballpark kind of a close counts kind of a calculation. That's very okay. But that gets us right in the middle of our range here of 14.2, 13.8, and 14. And I can average these three out, and I would get 14. So if I added these three divided by 3, I get 14%. Or just choose the midpoint, which is kind of what they say down here. Then it says, why is the cost of retained earnings cheaper than the cost of issuing new stock? Well, the reason is if I use my own retained earnings, it's just more efficient. It's just way easier. If I sell new stock, that requires that I go through an underwriter, an investment bank, who will then take a percent. And it could be 10 to 15%. It just depends on the size of the issuance and the market reputation of the company. But 10 to 15% is not crazy. So if I'm trying to raise $100 million and 15% goes as a commission, I only get $85 million out of that. And also keep in mind that to some degree, stock price is based on supply and demand. So if I issue more shares of stock and there really isn't extra demand for those shares of stock, my stock price comes down. Okay, so there's a supply and demand component to issuing new stock also. So the markets may take that as a negative signal now and drive down the stock price. Now, ideally, of course, if you are issuing stock to raise money to invest in the business, ideally then whatever you use that money for gets a greater return, and ultimately the stock price will come back up. That's the goal. But in the short term, the stock price will quite often come down. So they're going to just take our dividend cash flow model and add one more concept to it, which is flotation cost. So the F is flotation, and in this example, they're going to go with the high percent here of 15. So they're going to say D0, that dividend today of $4.19, times 1 plus G, the growth rate of 5. Divide that by P0, $50, times 1 minus 0.15, and 0.15 being the flotation cost. And we get 15.4%. So that's higher than 14, right? So just using our own retained earnings, the cost was 14, but if I issue stock and have to incur the 15% flotation cost, now it's 15.4%. So what's the WACC then? If we kind of ignore the flotation cost, we go back just to our 14%. It's just a matter of filling in the numbers, and we get down to 11.6%. Okay, so now think of that 11.6 as a baseline. Okay, so and also keep in mind that there are things that we can and that we cannot control when it comes to the WACC calculation. So what I cannot control is the market conditions. What's basically going on in the economy right now? Are we in a boom period? Are we in a downside period? What's the mood about interest rates, tax rates, the regulatory environment, international, what's going on? All those things matter, and I do not control them. I just have to be aware, have my finger on the pulse of what's going on, maybe try to anticipate what I think will happen, and adapt and adjust. That's what all businesses are doing continuously. Okay, but what I do control is I do control my capital structure. What's the weighting? What percent goes to debt versus preferreds versus equity? I do control the amount of dividends that I pay, right? If I'm in a super growth mode, I probably shouldn't be paying dividends. I should be explaining to my investors, we're growing, the growth is great. It's going to give us future revenues, future opportunities, future higher income. let us keep our earnings for now to invest in the business. And at some point, then you're going to have a greater return if you're willing to wait, right? That's the kind of thing you have to communicate with your stockholders. Then, of course, your investment policy. Keep in mind that businesses are continuously investing in new things. They're continuously presented with opportunities. Sometimes those opportunities are very simple. I need to buy another delivery van. Some machinery is wearing down. New technology has come out. If I buy that, that should hopefully increase my efficiency. I have the opportunity to expand in some new markets, launch new product lines. So businesses are continuously investing in something. Just think of businesses you work for and think of what those might be. Okay. Now, some of those projects that you undertake might be of very high risk. Some will be very safe. It just depends on the nature of it. If I have a manufacturing facility, I'm aware there's new technology that is much more efficient. If I buy that and use that, maybe I can reduce my labor cost. I reduce waste. I would do the math, right, and go, okay, it's going to be expensive. It's going to cost me some serious dollars, but I'm going to get this great return on that. That's a safer project. If I'm launching into a brand new region or territory that I'm not familiar with, and I'm kind of learning on the fly, and I'm building a new building or something like that, there's more risk in that, right? So I have to keep in mind what's my tolerance for risk as a business, right? Do I want a mix of safe, risky in the middle? Do I want to always play it safe? What am I looking for as I go about doing this? Okay, so firms with riskier projects generally have a higher WACC. And keep in mind the industry you're doing this in matters also. Some industries will just require more risk. Some will not. Okay, that's part of the nature of it too. Now, we came back and we calculated the WACC for our model company here. We came up with, I think it was 11 point, oh, I forgot the number already, 11.6, I believe. I lost my number. Right here it is, 11.6. Okay, that kind of said that's a baseline. Okay, that's a starting point. It doesn't mean we always use that amount when it comes to making decisions. Okay, so should the company use the composite WACC as the hurdle rate for each project? Hurdle rate, think of what a hurdle is, something I have to clear, something I have to jump over, and the answer is no. It very much depends on the risk of that particular project that we're looking at. So the WACC of my firm is 11.6, which is an average. That includes risky and safe and middle ground projects all boiled into that 11.6. So what I have to do is, as I analyze every project I invest in, I have to go through and figure out what's the risk of this project. If it's a riskier project, and you can kind of get that judgment call by experience and knowledge within the business, knowing your industry. If I'm doing something I've never done before, if my company is launching a product line it's never done before, if my company is going into a region we've never entered before, if we're now going international for the first time, we've never done that before, it's safe to say those are riskier projects because it's new to the business, right? If I'm replacing old machinery with new machinery, that's old hat. That's something I'm always doing, right? I understand how that process works. I know how to do those calculations. That's much less risk, right? So it's a judgment call just based on experience, knowledge, know-how, having data in front of you, looking at that data, analyzing it, figuring out what the certainties or uncertainties are, and going from there. So it's really important that we risk adjust. So we start out with 11.6, and we either say, this project's riskier, I need a greater return, or this project's pretty safe, I'm okay with a return less than that. And so the next slide talks about that. It says, it says here the company correctly risk adjusted the WACC. It would select project L and reject H. If it didn't risk adjust the WACC, then it would be the other way around. Okay, so basically it's just a matter of knowing what your WACC is and knowing what the risk on a project is and just making the right decisions. So that's the purpose of the WACC and how to calculate it. And really then the next couple of chapters build on that. So we're going to take a look here at chapters 12 and 13 I'm sorry, not 13, 12 and 15. And those chapters will kind of build on what we just figured out with the WAC. So we're going to figure out cash flows in chapter 12, and we're going to do a few other things too in upcoming chapters that will help you all kind of figure this out. So I should mention 10, 11, and 12 really kind of just go together, 10, 11, and 12. Okay. So if you have questions about that, just let me know.